Hello friends, welcome back. In this session, we are going to learn about the principles of accounting. Basically, the principles of accounting are the fundamentals of accounting or fundamental assumptions of accounting, based on which the financial statements are prepared. We need to know the basic assumptions on which the financial statements are prepared. There are three fundamental principles of accounting. The first concept is the business entity concept. We are going to learn this concept in the current session, and the other two in the coming videos. What is the concept of business entity? The business entity concept says the business is treated as a separate entity from its owner, which means that the business is separate and the owner is separate. Before moving further, let me spend a few minutes on various types of businesses. There are many types of businesses, but a few are important ones. The first important one is the sole proprietorship. Sole proprietorship means that the company and the business are the same. If anything happens to the business or the owner, there will be no difference in the business entity. The second one is partnership. In partnership, if anything happens to the partnership, it affects the partners. Let us say that tomorrow, if there is a huge liability on the partnership, the partner is bound to pay those liabilities. However, if you are treating it as a private limited or public limited company, then the liability of the owners is limited to the amount of shares for which they have subscribed. Let us say that you buy shares of Apple from the stock market and your liability is limited to the price, which you have paid in the stock market. Let us say that tomorrow there is a huge liability in the Apple shares and the creditors say, we need this much money from Apple. They cannot ask you to pay this money because your liability is limited. You pay the share price and that is all. You don't have to pay the share price. The Apple company has to pay for anything else. With regard to your liability, you don't have to pay anything over and above the share price of the company. In such a case, whatever happens to the company has an effect only on the company and not the owner. In this concept, we assume that the owner is absolutely a different person, and the company is absolutely different. Any effect on the company will not impact you, and if anything happens to you, it does not affect the company. In fact, the company is treated as a separate entity altogether. It is like you and me. It can buy shares, it can sell shares, it can make investments, it can manage the business like we can do individually. This is a concept of limited liability, which means that your liability is limited to the value of shares, which you have agreed to pay. Let us say that you agree to pay an artificial intelligence company at a share price of $20 per share. You just have to pay $20. If there's any liability on the company, you don't have to pay. Second, the financial statement only talks about the activity of the business. They don't talk about what the owner does or how the owner is performing. It is very much limited to do the business for which we are looking. For example, the Coca-Cola Company's financial statement only talks about the business of the Coca-Cola Company. It doesn't talk about who the shareholders are, what they are doing, if they made money or lost it. No, absolutely not. It only talks about the Coca-Cola Company and its businesses, which is the objective of a financial statement. I hope you've enjoyed this session, and in case you have any questions, queries or doubts, feel free to send us an email or connect with us. Thank you friends, have a nice day and see you soon.